All attendees are in listen-only mode.
Good afternoon and welcome to our webinar, Unpacking the Puzzle, Getting UK Manufacturing Productivity Growth Back on Trend. Thanks for joining us today. For those of you who don't know us, EF is the voice of UK manufacturing and engineering and a leading provider of business support. Everything we do is designed to help manufacturers compete, innovate and grow. My name's Lee Hopley and I'll be moderating and presenting in this session. Before I start, I'd like to draw your attention to a couple of points. Firstly, you'll notice in the pane on the right of your screen that this webinar is being recorded. Within the next 24 hours, we'll send the link to enable you to view the slides again should you miss anything. There's lots of us online and we're keen that you interact with us as much as possible, both during the webinar and afterwards. So you can send us your own questions for the presenters today using the chat box feature. I'll try and get through as many of those as I can during the webinar. I know this is scheduled into your diaries for 45 minutes, but time is precious, so we're going to aim to keep this closer to 30 minutes today. So let me introduce you to today's other presenters. You've got me on the left there, and we're also joined by Chris Richards, who's Head of Business Environment Policy, and Francesco Arcangeli, who's an economist here at EEF. The reason behind today's webinar is to talk about productivity. Everyone's been talking about it for what feels like a number of years now. We recently published some research looking at what's been happening with manufacturing productivity really since the financial crisis. And we're keen to understand how manufacturers view productivity within their business and within their sector, and to understand some of the drivers and obstacles to improving that. So if you've tuned in today to find out how to improve productivity within your business, you may be disappointed. This is really enabling us to feed into policymakers so they're making the right policy decisions so we can increase productivity across the manufacturing sectors. So let's get into the detail. So as I said, manufacturing productivity has been under the spotlight for much of the last decade, and that's really because we've seen something of a flatlining in performance, and that's something that is often coined as the productivity puzzle. This has not always been the case. In fact, in the couple of decades leading up to the financial crisis, manufacturing was a bright spot in the UK economy. Productivity growth was roaring ahead, certainly faster than most other parts of the economy. We also see quite a lot of sectoral variation underneath the surface of manufacturing. I'm always keen to talk about how manufacturing is not a homogeneous sector. There's lots of very different drivers of performance underneath the surface. And we definitely have seen that since the financial crisis, with some sectors bucking that flatlining trend and others much more challenged. In terms of what is behind some of the challenge that we've seen to productivity growth over the past decade, we've not been able to zone in on one particular answer or one particular reason that can explain what's going on. So what we've done is put the spotlight on a range of factors, and really we are looking to canvass the views of industry, individual businesses and their stakeholders to get your insight into where the problems and bright spots might be. Right, let's kick off with some of the data that we've analysed, starting with the good news. So I said up front that manufacturing has seen some challenges since the financial crisis, but historically has been a pretty strong performer in our economy. And I think that is clearly illustrated in these three pie charts here, where if you look at the period from 1994 to up until last year, manufacturing productivity growth increased by 66%. So when we're talking about productivity growth largely throughout this presentation, we're talking about a measure of output, GVA, used by official statistics, per unit of labour, and we're measuring that on an hourly basis. Now, if we could contrast manufacturing performance to services, we've seen productivity growth running at more than twice as fast as services and the rest of the economy. So clearly, if we're looking at improving productivity growth across the whole economy, manufacturing must surely have a strong role to play. So if we look at how productivity growth has evolved compared with other countries. I think this is something that we don't often spend a lot of time contrasting our performance with the rest of the world. And we know from an individual business perspective, that's pretty important. So again, we're looking at the period from the mid-1990s up to the present day, and looking at the trajectory of manufacturing productivity growth over that period. It's been pretty robust compared with some of our European competitors. And for the purposes of our research, we've zoned in on Germany, Spain, and Italy, really for the reasons that they've got a comparable size and structure of manufacturing base to the UK. In each of these charts, the UK will always be illustrated by the pink line on the chart. And as you can see on the left-hand side, that's running ahead of our international competitors. But if we look more closely at the period since the financial crisis, so the chart on the right since 2009, it's been a much more subdued picture in terms of manufacturing productivity growth, with the UK really lagging behind the rest of the pack. It's not been a stellar performance from any European country over this period by any means. It's been quite sluggish for all countries since the financial crisis. But there does seem to be particular challenges that the UK has faced in driving productivity growth throughout this period. Now, if we look at how some of the sectors have, what this means in terms of productivity levels. So on the face of it, this is potentially a little bit of a complex piece of analysis. We've constructed some ratios of productivity levels between the UK and other countries. But essentially, boiling this down, anything above the pink dotted line means that the UK is more productive. Anything below the line shows that productivity levels are less competitive than our European comparators. So as you can see, back in 1995, our starting point was considerably weaker than that of Germany, Italy, or Spain. So we were only about 80% as productive in terms of output per hour compared to Spain and Italy. The stronger growth that we saw over that period, illustrated in the previous chart, means that the UK actually overtook those countries running up to the financial crisis. Didn't make a whole lot of a dent in the gap with Germany. But the sluggish performance thereafter means that we've clearly lost some ground with our European competitors. Now we'll take a look at manufacturing subsectors. So we're back to just focusing on a UK perspective now. So really this chart is illustrating some of the big differences that we see underneath the surface of manufacturing. So when we dig into subsector performance. So we've highlighted a couple in particular. So if we start with the line right at the top there in orange, that's the pharmaceutical sector. Really very, very robust productivity growth over the 90s and the first decade of this century. So really racing ahead of all other manufacturing sectors. But the brakes certainly slammed on there when you look at the performance following the financial crisis. So quite a sharp drop in output per hour after that period. In contrast, languishing more at the bottom, we see the food and drink sector. So that's the pink line, much more kind of steady as she goes, much more subdued performance. And really, we've got everything in between when we look at industries such as chemicals, other transport, and mechanical equipment, for example. And you've got manufacturing essentially just in the middle there. So really want to spend the next few minutes looking at how three of these sectors compare internationally. And there's quite different stories that are revealed in terms of performance in the run-up to and after the financial crisis. So if we start firstly with the transport sector. So this includes motor vehicles and other transport. And as you can see, a story that is not dissimilar to the overall manufacturing picture. You've got the UK bar rising faster than other economies since the early 1990s. So a robust performance, briefly interrupted by the financial crisis there, that clear dip in 2008. But actually, the sector has mounted a pretty respectable recovery, as other European countries have done, with the exception of Italy here. So that's a sector that seems to have shaken off the disruption from the financial crisis and continued to see its productivity grow thereafter. Now, if we look at how this compares in terms of the competitiveness of productivity levels, again, we're seeing a story that is familiar right across manufacturing, where our starting point in the mid-90s was actually substantially weaker than that seen in comparable countries. So the robust growth that we saw, particularly versus Spain and Italy, saw us closing the gap somewhat. The chart on the on the left, but really the gap with Germany has remained pretty wide. The transport sector is quite a broad church. So the charts on the right have tried to break this down into motor vehicles and other transport. Data isn't available in terms of output per hour, so we've looked at this in an output per worker. But again, we can see quite a different story in terms of motor vehicles, automotive productivity performance, which has been much stronger, and we've definitely held our own to a greater extent against Spain and Italy than other transport. Now, in the UK, we see this as predominantly aerospace, but that's not necessarily the case in some of our comparator countries. But we've still got quite a big gap in terms of productivity levels with the UK and our three comparator countries. Now, the next sector we want to look at is pharmaceuticals. So if we remember looking at the subsector performance within UK manufacturing, that was one of the real standout performers. Phenomenal productivity growth through the couple of decades running up to the financial crisis. That feels like it's characteristic of the sector everywhere. So a fairly similar trajectory in terms of productivity growth in Spain and to a slightly lesser extent in Germany, but pretty robust growth in all of those countries. And the financial crisis clearly interrupted productivity growth in most of our comparator countries as well. So the big drop that we saw post-financial crisis in the UK is something to worry about. But if we look at the next chart, it shows that our starting point was so much stronger back in the mid-90s compared to what we saw in transport and in broader manufacturing. So we've historically had quite a strong lead in productivity in the pharmaceutical sector. And that really, we really did make hay with that through the 90s and noughties. At one point, just before the financial crisis, productivity levels in the pharma sector in the UK was, more than 3 times that seen in Italy. But clearly the drop that we've seen post-financial crisis has done some damage to that lead. We still have an advantage, but nothing like as strong as it was some 10 years ago. Now, if we flip onto the final sector, so this is one that I find particularly interesting, the food and drink sector. I think that, this is often seen as, something of a problem child within manufacturing, because it does tend to have a much more sluggish productivity performance relative to other parts of manufacturing. But again, this seems to be something that is characteristic to the sector as a whole, rather than something that is a UK phenomenon. And if anything, productivity growth across the sector in the UK has been much firmer than that's seen in other economies. So we're kind of consistently outperforming in terms of productivity growth. And that is again reflected if we look at the next chart, which looks at productivity levels. So really since the mid-2000s, productivity levels have been running ahead of that seen in other countries. So ultimately, hopefully what that's given you a flavour of is that when you really dig into some of the sectoral data, the productivity puzzle is a bit more complex than simply talking about an overall flatlining across the UK economy. And that's really where we want to dig into some of the reasons that might be sitting behind, particularly the differences that we see in manufacturing subsectors. So we're going to move on to explore what some of those factors might be, both in terms of what's been driving strong productivity growth in the past, but what might be contributing to subsequent weakness. Before I pass on to my colleagues who are going to run through some of the drivers, a couple of questions. One I particularly want to pick up on, which is our choice of country that we've looked at, and the absence of comparisons with the US and France. I mean, this is essentially due to availability and data comparability. Our use of Eurostat data means that we don't have a good data set for the US. It would have been good to have that as a comparator because, we know that is a standout performer globally. And there are issues with the way in which the French data is broken down by sector, which means a true comparison can't really be drawn between the UK and some of these other countries. If you want a fuller explanation for some of that technical detail, you can find that in the report. Right, I'm going to hand over to Chris and Francesco now, who are going to dig into some of these drivers.
Brilliant, thanks, Lee. And as you mentioned there, one of the key things that we've seen across manufacturing is that all manufacturing sectors have contributed positively to productivity growth pre the financial crisis, but afterwards there's been some divergence. And that's what we really wanted to dig into, which we looked at both in the report itself, but also in the next couple of slides as well. So looking at the factors that might explain this, to drill down to what needs to happen to get essentially productivity growth back on trend. We've been taking as read the need to address skill levels. I think that's a well-established part of the debate in terms of some of the challenges within UK manufacturing. The role of infrastructure, where the government has done some good work looking at infrastructure over the last couple of years, and the need to increase R&D spending and collaboration, where there's a wider piece of work being done as part of the industrial strategy, looking at that and the link to productivity. What we are going to be looking at today, and this is also reflected in our report, is investment in capital equipment as one of the key areas that we need to tackle, labour flexibility and labour content within manufacturing more broadly, company size, does that have an impact on productivity levels across the sector, leadership and management capability, a key topic that's been kind of discussed over the last couple of years, and lastly, diversity of operations within manufacturing, which we reflect on and call the complexity of manufacturing production. So the first one to look at is underinvestment in capital equipment. I mean, this theory remains quite dominant as an explanation, with the UK lagging behind international comparators in terms of levels of investment. As the chart shows there on the right, you can see the UK, the pink line, languishing behind our comparator countries, Germany, Spain, and Italy, in terms of levels of investment in machinery and equipment as a share of GVA by country. With Italy there kind of being the standout performer since 1997. But a more recent study done by ONS looked more closely at productive stock. So this is the level of available capital stock within the manufacturing sector. And this chart here on the right again shows that actually productive stock peaked back in 2000, but the ratio between capital and labour investment shows carried on until the financial crisis, where it then flatlined. So there's a key phenomenon here in terms of the levels of productive stock within the sector peaking far earlier than we would expect, given the levels of catch-up investment that continued afterwards as well. It's also interesting to note, again, we reflect on this in the report, that manufacturing is the only UK sector which has a contraction in net capital stocks between 1998 and 2016. So if you look at some of the other sectors across the economy, manufacturing contracted. But again, given the divergence across sectors, we've also seen that within manufacturing as well. So transport equipment and pharmaceuticals increased their capital stock between 1998 and 2016, whereas chemical sector decreased their levels of capital stock across that period. Given how those sectors have kind of performed, suggests that the capital equipment investment isn't necessarily going to be a silver bullet when it comes to addressing the wider productivity challenge, and there might be other factors at play that need to be tackled. The flip side of that then is looking at the rates of labour content within UK manufacturing, and this is linked to that last point around capital equipment. So value added in UK manufacturing relies much more on labour than capital compared to our international comparators. And as the chart there on the right shows, the UK in terms of GVA has a higher share linked to consumption of fixed capital has a share of consumption fixed capital lower than some of the other countries in our study. So you can see there's 14% of GVA linked to consumption fixed capital, whereas in Italy that's much higher at 25%. And equally, you can see there as well that in the UK, 66% of GVA within manufacturing is linked to the use of labour, and that's the highest across the comparator countries that we looked at as part of our study. And it's key to note as well that that trend has increased since the financial crisis across manufacturing. But the subsector picture is quite a mixed one. This is where we'll kind of look at what is capital stock within the sector and capital gap. So this chart shows effectively the capital gap across different manufacturing subsectors. A higher value on the chart means that there's more intense use of capital within that sector. And what you can see there from the chart is that sectors like pharmaceuticals stand out in the UK as having a higher share of capital equipment use, but they underperforms, even pharmaceuticals underperforms against countries like Germany, which suggests that there's, again, a greater share and use of labour within UK manufacturing compared to other countries. And the last point I just wanted to make in terms of labour content as well is we've been investigating this kind of widest look at whether or not relaxed labour laws in the UK may be one of the reasons why there's an acquisition hurdle, a low acquisition hurdle for labour compared to capital. So it might be, for instance, that in Italy they have a higher share of investment in capital equipment because it's much harder to recruit, and the flexibility around labour is not there, whereas in the UK it is. So the argument for investing in labour might be an easier argument to win, say in the boardroom, than it might be for capital, and that's one of the things we explore a little bit more in the report. But what I'm going to do is hand over to Francesco, who's going to take you through the next slides.
Yeah, thank you, Chris. The next factor is about management practices, and everyone has the feeling that good management practices may improve the quality of your job. However, it's not always that easy to measure how these may improve productivity. In our analysis, we use a couple of interesting surveys which highlight the relationship between the two. And here you can see the first study, which is extremely recent and has been published by the ONS. It shows how companies using good practices, such as the use of KPIs, for example, or targets, pay rewards related to individual performances, are also those with a higher productivity. And in the graph are those, for example, on the 9 and 10 management score, which we can see that have much higher productivity compared to those on the left-hand side of the chart. Usually these companies are large, operating in more than a country with employees with a qualification higher than the average, and usually they are not family owned. The second survey is a study commissioned by the London School of Economics and tend to confirm these findings. This study analyzed not only UK firms, but also French, German, and American. And these last two countries, which tend to have productivity levels higher than the UK, have also better scores in terms of management practices, as you can see from the chart. Interestingly, the UK have firms with management practices scores across the entire spectrum, from extremely poor to top class. So the UK score is actually the average of an extremely heterogeneous sample. This characteristic does not appear to be present in Germany and the US, and this might confirm how our country has a long tail problem with some firm actually dragging down overall productivity. The next factor we analyze is what we call more complex business operations. Several times we hear that UK manufacturers are more focused on services around manufacturing, and we try to understand if data actually back this theory. We took a look at output data by subsector, and we actually noticed that the total core business production level is pretty similar to the one in the other comparator countries. Just a note, when we say core business activity, we mean pharmaceutical companies producing drugs or transport manufacturers producing a car. The UK manufacturing core output has a share of 93% of total output. The graph here is considering differences between UK and comparators. So a positive number means that the UK has a stronger focus on core businesses, and of course vice versa with a negative one. So as I say, if you look at the left-hand side, manufacturing has a level pretty much similar to the one of Italy, Spain, and Germany. However, looking at subsector, we notice some really interesting stories. The first is that each UK subsector is actually less focused to core production, excluding pharma and production of coke and petroleum products, which is not in this chart. The difference for pharma, as you can see, is really massive. It is also interesting to notice that historically, and this is something you can see in our full report, pharma had a larger share of non-core output, which in this case, the top one is research and development. And the collapse in productivity followed the same line as the decline of importance of this non-core activity. Another interesting story regards, for example, mechanical equipment, where UK look to be not so focused on core activities, and actually the share of the first non-core is 12% of the total, so a really high one. In this case, the non-core top activity is repair and installation of mechanical equipment. So it looks like UK firms are more focused on the final part of the supply chain, so maybe about more installation and repair and possibly assembly. The last factor we analyze is about company size. And the average UK manufacturing company is bigger in terms of number of employees than Italian and Spanish companies, but way smaller than Germans. Again, looking just at manufacturing may not be enough. So indeed, some sector differences are massive. And we can see that from the graph. As a clear example, motor vehicles, which has a really important difference with average German car manufacturers, which are almost 7 times bigger than an average UK company. So possibly Germans are able to exploit better the benefit of a true economy of scale. On the other hand, notably, UK companies are bigger in the food and drink sector, which was also one of the best performers in terms of productivity when compared internationally. Not in this slide, but in our full analysis again, we also took a look at the evolution of the size. The situation is quite stable throughout years, with a major exception, which is the pharma sector. This sector reduced its size since 2009, whereas Germany increased it, and we are talking about average size and also the share of very big companies, so those with 250 employees or more. And this is a hint how there is a possible correlation between the reduction in size and a contracting productivity. With this, I will now hand over back to Lee for some final remarks and questions.
Thanks, Francesco. We've got a couple of questions coming in. I think we've got time to take those before our 30-minute cutoff. One of them actually came in earlier asking about what was behind this strong growth in pharmaceuticals productivity in the run-up to the financial crisis. I mean, some of my thoughts on that are really the R&D intensive nature of that, the fact that UK industry was really at the forefront of producing some high value, the big blockbuster drugs. It was very R&D intensive, as you alluded to. And I think in some of those areas, that's where we've seen some change since the financial crisis, which, may be driving some of the pullback that we've seen. Guys, have you got anything else that you wanted to add to that?
Yes, so the growth in pharmaceutical was actually massive, and as you say, probably related to R&D. Indeed, profits went up in a really important way, and also in the same period, GVA growth was massive, and also the reduction in hours. After 2009, we noticed a sharp drop in profits, and so in GVA, and a stable situation in terms of hours. So a contracting numerator, and actually hours staying stable. So of course the ratio in terms of productivity had a big fallout.
Thanks, Francesco. I mean, in terms of the future, someone's asking, do we think the size of manufacturing in the UK will continue to reduce compared to countries like Germany and the US? I mean, I think in terms of the share of manufacturing in the economy, it's been fairly stable over the last couple of years, and it's not significantly different from what you see in the US. I mean, Germany's really an outlier. I mean, it's managed to hold its share of manufacturing in the total economy at above 20%, which is quite unusual. I mean, most other developed economies have seen some reduction in the relative size of its industrial sector, over the last two to three decades. So, I mean, I would imagine that the evolution wouldn't move in a significantly different way from that in the US or France, for example. Coming back to productivity, one quick question on some of the driving factors. So, Chris, you talked a bit about capital intensity. You specifically looking at investment in robotics and automation. I mean, there's a sense that we don't compare well there. Is that likely to be contributing to some of the productivity differences?
So yeah, in the wider analysis that we're doing, which doesn't feature in the report, we're planning to look at the impact of robotics and the relevant shares. The initial work that we've looked at suggests that we do underperform in that space as well. So in our investment monitor report that EEF put out last year, we kind of compared statistics from the Institute for Robotics, which kind of recognize that actually Italy massively invested in robots compared to the UK. But all I'd say is just reflect on where that has resulted in terms of productivity levels. So we've got productivity levels in Italy being at or just below the UK productivity levels. So the payback on some of this might be more broader related to some other factors, for instance, leadership and management, which Francesco talked about, or just the wider risk appetite as a result of how we appraise investment decisions in the UK.
Thanks, Chris. Right, I'm trying to keep this on track. So let me sum up and let you know what our next steps are going to be. So, I mean, hopefully that's given you some insight into the way in which we're trying to kind of unpack what many people see as a productivity puzzle. It's not been the same for all sectors within manufacturing over the last 10 or 20 years. So it is really important that we get a better handle on some of the drivers and differences in performance across manufacturing, because I think particularly as we look to continue to engage with government on the development of its industrial strategy, how it prioritises its resources and its efforts, I think, is going to be pretty key. And we want to make sure that whatever policy actions come next are really making a difference to industry. So we're really keen to understand if what we've outlined, some of the factors that we've identified, how that stacks up and tallies with your own experience, whether it's on management and leadership in your own business or in your supply chain, issues around investment, how you measure your own productivity and how you've seen that evolve. So there's lots of ways in which you can feed that back. There's a call for evidence that you can take part in. You can drop us an email, sectorproductivity@ef.org.uk. Lots of materials that we've been producing you can find on our website on our hub, ef.org.uk/sector productivity. We'll be continuing to chat and engage on this topic on social media. So EF_economists is how you find us on the Twitter, and we're also on LinkedIn. Thank you ever so much for joining us. Thank you to Chris and Francesco for joining me today. I hope you found that useful, and we really look forward to engaging with you further on this really important topic. Have a great day.